Good morning, everybody, and welcome to the final webinar in this MDA 360 series. I'm Toby Potter, the chair of IMAP, and it's my pleasure to be joined live today by Mark Watmore, our partner at NMG Consulting Group. And Mark will be talking to us about some of the strategic challenges that face the advice community as they decide to adopt managed accounts and the shape of managed accounts or type of managed accounts that they choose to adopt, and what the data is telling us about the decisions that they're making. Before I hand over to Mark, I'll just say a little about the MDA 360 program. So for those of you who've joined us during this week, you'll know that we've dealt in quite a bit of detail about some of the more technical aspects of running an MDA program. All of those sessions are available through IMAP Connect, accessible through the IMAP website. All of those sessions on IMAP Connect are CPD accredited. So if you would like to revisit any of the sessions that you've either seen or missed, or you'd like to share with your colleagues the content from the webinars, all available through the IMAP Connect part of the IMAP website. Coming up through the rest of the year, 3 full-day in-person masterclasses in Sydney, best practice advice in October, where we'll be joined by Simon Caradis from Hamilton Locke, James Zoe from Acambo, Head of Compliance at Acambo, and Luke Brixton from First Financial to talk about, in detail, the way they give advice on MDA programs. Then the day ahead of our Leadership Summit, we'll run another session of our Responsible Manager Masterclasses with Simon. Many of you will have attended that Responsible Manager Masterclass, tailor-made for MDAs and the obligations of an MDA RM. Too many acronyms in this world. And then finally in December, a session with Sean Pascoe of Crow and Jenny Mulders, the chair of our regulatory group, on setting up a risk management framework, identifying, quantifying, documenting, monitoring, managing risks, particularly with an MDA focus. So those represent a really deep dive into the specific requirements and obligations of running an MDA service. In November, 2-day summit, the IMAP MDA Leadership Summit. This follows the release by ASIC in perhaps late September of the updated MDA instrument. So we still don't know what will be in the instrument, but I've been told that it'll be released in mid to late September, and it'll have a go-live date in October. So about 4 or 6 weeks later, we'll be running our summit to review what the new MDA instrument means, changes that it will necessitate for the operation of advice programs. So the MDA 360 program is made possible by the participation of specialists such as Mark today and the others that you see on the screen. They bring with them a depth of expertise specific to MDAs, and I'd encourage you to take part in our further activity. Now, this MDA 360 program has been made possible by the support of Mason Stevens, and now I'd like to invite Nick Mitchell for the last time to join us and talk a little about Mason Stevens and its MDA support. Thanks, Nick.
Thank you, Toby, and thanks to everyone attending today. Happy Friday. We are very proud to be partnering with IMAP for this series to really demystify the finer points of establishing and managing and advising clients under an MDA service. For those who aren't familiar with Mason Stevens, we're a platform that's been at the forefront of MDAs for over 16 years now. We're the only wealth platform in the country with an integrated MDA offering. So we're very, very confident we understand what it takes to deliver an exceptional managed account experience, not just at the portfolio manager level, but right through to the end client. And that experience runs deep. The majority of funds on our platform operate under an MDA license, and this drives how we have developed our service proposition and our platform technology roadmap, which is really dedicated to ensuring that the MDA service works seamlessly. We are a team of investments and markets people, so delivering exceptional financial outcomes is exactly what we try and do every day, whether that's utilising our live trading desk, assisting with governance and investment committee frameworks, providing IC representation, or delivering analytics and reporting. We've got a suite of services that our clients utilise that enables our clients, our partners, to deliver the best portfolio outcomes for their clients, particularly in the wholesale and high net worth space. That's enough from me. I'm really looking forward to hearing from Mark. I'm very familiar with his business and what they do. They've got quite an impact. It should be a great session. Please reach out to myself at any time if you want to have a chat about how Mason Stevens can assist. But for now, I'll hand it back to Toby and Mark and to begin the good stuff.
Thanks very much, Nick, and thank you very much for your support to date in bringing MDA 360 to life and in our future masterclasses. So one more word about an upcoming event. Alternatives are becoming an increasing part, particularly of MDA portfolios, and we'll be taking part in the Sydney Alternatives Week on the 16th of September in a session called Alternatives and Discretionary Portfolio Management that we're hosting for the afternoon of the 16th. I'd encourage you to ask questions. We've had a lot of questions as we've gone through the week, and they've been good, detailed, interesting questions. So please, if there's something you'd like to understand a little more or a question you'd like to put, don't hesitate to put that in the Q&A at the bottom. So Mark, over to you. Thanks very much.
Thanks, Toby, and thanks for having me be part of this webinar. Just for those of you who don't know us, NMG Consulting, we're a strategy and insights firm. We just work in wealth asset management and insurance, and we are passionate about the industry. Spend a lot of our time talking to advisors and then advising different parts of the industry. And it's particularly is fed by the sort of insights that we get from talking to advisors. So today, as a bit of context, just wanted to run through some of the insights that we have around what's going on with managed accounts. It's clearly been a massive growth area for the industry in recent times. So we've had a lot of interest in it, and also try to complement the great work Toby and IMAP do in the space as well. And then I think we'll have a conversation and take some questions as we go through. So firstly, I think if we take it up a level, when we're talking to advisors, we want to understand how are they actually building portfolios. And the key ways advisors still build their portfolios is one, do they use a diversified fund there are still advisors who do that, or it may be just for a small cohort of their clients, and that can be via an industry fund. Back in the day, that would have been via a multi-asset fund with one of the master trusts. Managed accounts is another way via an SMA or an MDA structure. We'll get into the growth of that in a moment. Model portfolios. So these are what we call paper models. Advisors either following them strictly or as a guide. And then self-select, which is essentially advisors still building somewhat bespoke portfolios for each client. And we can argue whether that's appropriate that all advisors would be doing that, but it is still a major factor. So I think the key point we're looking at here is managed accounts. This is from a FUA weighted percentage of the market. It's grown over the last few years to 30% of FUM. So that's essentially 30% of the retail advised market is via managed accounts, and growing at 4% a year. That's 4% of the back book of the industry moving at a FUA weighted basis per year. That's a massive change. You can see that it primarily comes at the expense of models, which is clearly the natural place where advisors ran a paper model. It was highly inefficient. and you can run that model by a managed account. No surprise there. Also seeing more and more take up at the expense of diversified funds. Not because, I guess in the past, managed accounts have been seen more as a structure for upper affluent to high net wealth, but there are now with the growth of compact menus and really low cost SMAs that drive some of those. We're seeing advisors move out of what they may have been on something like a master key multi-asset into a lower cost SMA driven compact menu. So we're seeing growth from there as well. What's also interesting here is that self-select. So obviously advisors that are still saying building portfolios as part of their proposition remains the largest by FUM, and it is the largest by advisors still. That surprises many because, given that a lot of the market has moved towards managed accounts or more efficient style of portfolio building. But it does match the fact that advisors have over time, the advice industry has moved to be more high net wealth focused. And as we move to be more high net wealth, there's more advisors where building portfolios is a core part of their proposition and will continue to be that. So I guess what this tells us is that there is still a lot of opportunity for managed accounts to grow. We would expect models to continue to come down, particularly as managed accounts can offer flexibility for those doing models as a guide, i.e. not strict, but also as more of these people in self-select can be convinced that there's potentially a better way or a more efficient way to build their portfolios. Now, over to the right, if we just focus on those who are using managed accounts now, we know that, and you hear this sort of stat that there's 50-60% of advisors are now in managed accounts. But what that really breaks out into is we said there's primary users and non-primary users. So primary users are those who have got to the point where there's 60, 70, 80% of the book is in managed accounts, and therefore the business and the operating model of the practice has been transformed and is getting that level of efficiency from managed accounts. But the other half of the users are what we call non-primary users. So there is still cohort there who are trying it out. They might try an off-the-shelf SMAs out to see if it suits their portfolio. And over time, they are either, some of those will find that does suit their business. Some also don't. And we do talk to advisors who find that, we get feedback such as, I find an SMA way too strict. So I'm not quite sure if it's going to be for all of my clients. But at the same time, we find many of those advisors are also using SMAs as a core and with other things around as satellites to offer that flexibility. But there are also many of those non-primary users are on the road to being primary users. So we'd expect that's really providing growth to those in managed accounts, as that's when the big elixir money are moving into that structure. I will note non-users. There's also within non-users, we have those there is a bunch of advisors who they believe in the future they would consider SMAs or MDAs, and there are those who believe they won't. That being said, every year we test this, those who say they will never consider them, that amount is dropping. So I think that there are opportunities to convince those who've sort of ruled it out as a structure for them to over time be convinced that there are benefits in it for a practice and also for their clients. And talking of benefits, so one of the things we measure in talking to advisors is what's driving their use of managed accounts. It's been well cited over many years that efficiency is the big driver, and that it still reigns supreme in terms of being the biggest driver of this. I'll be honest, we don't believe if it wasn't for advisor efficiency, we would not be seeing the growth of the rapid growth of managed accounts. But at the same time, there are a number of other benefits of these which are benefits to clients. And they include here, they're in the light blue here, responsiveness to the market, there's cost benefits, transparency, things like performance and tax benefits. They've always been talked about as benefits of managed accounts. But it's only been the efficiency that's led to the rapid growth of them. But we're now at a point where I think as an industry, we're going to need to start focusing on what are the client benefits, and performance for one is one which clearly that would be should be an easy thing to demonstrate, as it is in any sort of investments or managed funds cohort. But when it comes to managed accounts, it hasn't been so easy because we just don't have the reporting and transparency to enable comparisons. As same with the tax benefits as well. So I think this sort of leads, there's the opportunity here for the industry to start to sort of come up with ways to demonstrate this. And we're starting to see that. I know when we look at some of the platforms, someone like CFS, if you look on even on their open website relating to their managed accounts, they've got very good performance comparison sort of hub in there, which is a sort of so they've been one of the early leaders in that, and I think that's an area where we're going to need to see more and more ability to compare. So when we think about managed accounts, I'm just going to focus here on SMAs because we know SMAs and MDAs are on platforms, but for a number of the platforms, it's very hard to measure or quantify the MDAs that are there. So in the last year, we've been at NMG, we've been working with platforms and with a number of the managed account consultants to try and build out a bit of a market share view of what's going on in terms of size and growth by consultant and by type of SMA. We will be focusing more on MDAs as we go forward, and we'll be working closely with Toby to try and help get a better picture of that. That when we focus on SMAs, this is a view of all of the major platforms in SMAs. I'll bit of an apology there, Nick, being that Mason Stevens are very focused on MDAs. They're not shown here. But from an SMA perspective, what we see here is the grey bar is each platform's market share of the platform market. The blue is their market share of the SMA market. So what's really clear here is that Hub24 have a very much oversized share of the SMA market. You're really no surprise they were an early adopter in managed accounts, and particularly SMAs, and have been very easy to work with for a number of practices and consultants, but at the same time have become the leader in terms of growth and market share growth of wrap platforms as well. So that has led to them both growing fast as a platform, but rapidly their proportion of SMAs is well over a quarter. What's also interesting here is I think the fact that North, Netwealth, and Panorama have the same market share. Someone like North, who I'd say was a late starter to SMAs, but has turned things around in recent years to be growing very fast and being very nimble, have now got the same market share as the Netwealth and Panorama in SMAs, which is quite interesting. And then you can see where all of the various platforms sit. What's down the bottom is the change in market share. And so for someone like Hub, they did see a drop in market share, so they're even higher in recent years. But it's not really due to them slowing. It's been more to the fact that someone like North is growing faster than market in their market shares. So and it's just, I guess, given that platforms are an essential part and have been a major factor in the growth of SMAs, it's always interesting to track sort of how they're going. Another thing we gathered through the work we did on for the SMA market report was information on SMA type, asset class exposures, and underlying product structures. So firstly, SMA type. So what we see here is that this is across the total total market in SMAs. Private menu, which is really tailored and white label, dominated by tailored, makes up 61%, and public menu or off the shelf makes up 39%. These splits been pretty consistent over time. One thing to note: some people are pretty surprised that public is so large. I think what we're seeing here is one is the call out there. These compact menus that are starting to take hold and getting growth into that sort of mass to mass affluent space, and they're often driven by SMAs, are boosting the public menu portion there. But at the same time, private has been pretty steady. In terms of asset class exposure, so we all know SMAs started as sector SMAs, maybe they're Australian equities, for instance, which was very common. It's grown to now 90% being diversified and only 10% being single sector. Clearly, single sector have a bit of a role to play here, still sometimes being nested within diversified, but the growth has been driven by diversified SMAs, certainly in recent years, and we don't see that changing because that's the part that's led to practice efficiency. What I find really interesting is the underlying product structure mix. So what we see here is managed funds at 58%, ETFs and LICs at 23%, and Australian equities at 15%. International equities within SMA is pretty small. So ETFs and LICs have been the part that's growing fastest here, more at the expense some of managed funds in some ways, but also from direct Australian equities. We're often asked why haven't ETFs become a bigger part of SMA portfolios, given that their structure is more efficient for trading, etc., and execution. One of the main things about a ticket to play and a factor that's clear within SMA portfolios is the discounting that's needed in order to bring the total cost down to client within the portfolio, and that's a benefit to clients as consultants and managers can negotiate those with underlying managers. But up until recently, you weren't able to do the discounting via ETFs. It was only by managed funds. So therefore, that led to most portfolios being heavily weighted towards unlisted managed funds versus ETFs. That being said, in the last year or so, a number of the platforms have started to facilitate discounting or rebates around ETFs. So we see that as a start to, I think we're going to see more and more ETFs within these portfolios over time. And given that there's been such ongoing growth of active ETFs, active ETF launches in recent times, we would expect that we'll see more of them being part of this as well. And we'll get to this point where we see if a consultant or manager can find everything they need in an ETF structure and can get it at the right price on the platform, you would start to see total portfolios made up of ETFs eventually. Okay, thanks, Toby.
Right. Look, thank you very much. So let's start to address some of the issues which you raised there. I mean, I think one of the strategic issues across the whole of retail financial services has been the challenges for active management. It's applied in funds. We've seen APRA putting pressure on the platforms around this. So how do you see this issue of active versus passive, or the challenge for active management playing out in a managed account context?
Yeah, and I think the underlying structure chart I put there, that 23% in ETFs, that is very, very much dominated by passive. So anything in a managed account structure that's an ETF is really passive at the moment. But active managers it's been a tough time for them in recent times, well known. And the growth in managed accounts has, I guess, it's an opportunity for some, but for others, it's been certainly led to them probably needing to take lower margins, given the discounting that sort of is demanded within those structures. The other thing that's going on in active is that in response to the sort of the dominant flow trajectory of passive in portfolios, whether they're in SMA or outside of, we're now seeing a lot of money going into lower cost systematic structures, styles, which is meaning, we're seeing lower tracking error, lower cost structures, number of managers doing really well in that, but it is at a lower fee. The other end of the fee budget, so we're seeing that barbelling. So passive, systematic. The other end will be higher voltage things like concentrated, long, short, or specialist structures, and then into alternatives outside of equities. So it's certainly been, it continues to be a tough environment, particularly for those managers who haven't got something that can fit into one of those buckets.
Yeah. There's a couple of questions that have come through, so we might just pick up on those. You obviously used the phrase responsiveness to market. So Anonymous, he or she, they are our most generous contributor to the question set. So what did responsiveness to market mean in that?
Responsiveness to market means when there's a change. I think one of the sort of the classic use cases we talk about why SMAs make sense is when there's a change and the portfolio manager needs to swap a manager or do a rebalance at short notice. And if that's market driven, back in the day, if that was a paper model, it would take months to actually get around to all the clients to get them to sign an SOA or do an ROA to make the change. SMAs enable that change to be made very quickly, so the response can be immediate.
There's a question here. There was you had a bar chart of showing composition managed funds, ETFs, direct stocks, and so on. There was an other. What's in other in that case?
I think the other can be things like direct bonds and things like that.
Bonds was the one that leapt to my mind.
Because it's certainly not
hybrids,
it's
bonds,
not hybrids and bonds, those sorts of things. Things that are at least daily tradable.
Yeah.
Obviously within SMAs we're not seeing illiquids aren't really a factor as yet within the core SMA, but we're seeing a lot of activity about how to make that work.
I think the ability to deal with illiquid investments, the ability to deal with client-specific investments is probably the frontier for managed accounts. And then there's a question in relation to MDAs. Do you see the market consolidating around a small number of scaled providers, or is there a sustainable future for specialist boutique MDA providers? What will determine the winners?
Well, is that one for you, Toby?
Look, my view. So I divide the MDA market into sort of three segments. There's Mason Stevens at the platform end. Mason Stevens and Dash, they are platforms with an MDA capability. Then there are a couple of hundred advice licenses that have an MDA authorization, and they range from the very large, like Shadforth's and Findex or the Findex Group, UBS, for example, a number of the brokers, so large practices down to, individual, one office, self-licensed advice firms. In the middle, Philo Capital, disclosure of interest, and implemented portfolios, part of the Evidentia GDG group. I am a fan and have been for 25 years of the MDA structure when supported by operations and technology and compliance processes. I just think it's a wonderful structure for the delivery of advice as a service. So my response to that would be, I don't think we're going to get to a point where we've got, whereas there are, half a dozen ETF issuers, and it's pretty tough for number 7 sort of thing. I don't think we're going to get to a point where there are 4 or 5 or 6 MDA providers. I think this is going to remain one of the key tools for well-run licenses. But, is my bias showing? Our conscious. So
I would say you can also ask that question, same question about SMA consultants or asset consultants that operate in that space. I think given where we are now and where we're heading, let's say there's probably 80 plus potential consultants in this area. The way the market looks now is probably not sustainable. People say, will we end up with just 5 dominant players? Yeah. I don't think we've seen that in any market in our industry. There is always a place for quality boutique players that are meeting certain client needs. Yeah. And that's in advice, that's in asset management, and I think we'd see that in this area. Clearly, everyone, there won't be room for this many, and the shape will change, but I don't think it'll be a point where that's just a handful of dominants.
Yeah, when I'm thinking about these issues, I look for sort of analogous markets, and the closest analogy is the asset consultant to industry fund market, and that has consolidated to a few large players. But I think advice has just got some fundamentally different characteristics than institutional investment management, a la the industry funds.
Well, the industry funds themselves have consolidated to be a dominant player, so there aren't as many customers.
Yeah.
So you go to how many customers are out there going forward for managed account services.
Yeah. And I mean, there are going to be, there are 5,000 licenses in Australia, so there are going to be thousands in the advice space. And I've always seen that sort of asset consulting portfolio management function as being driven by so technical competence and capability is a ticket to play, but once you get past that, you end up in the sort of EQ part of the service offering, which is this somebody I feel we could work with? Is this somebody who's got the same sort of view of how markets work as we have? So you're going to end up with a set of investment philosophy. So there's plenty of room for multiple investment.
People want alignment.
Yeah.
And that's an interesting point to raise, because we know from our advisor research, some of the the processes to select providers and partners, was pretty rudimentary, I think you would say, early in the stages of the growth of SMAs, and MDAs. But we are getting to the point now where there's maturity, and there will be larger licks of money that go back out to market and looking for a new consultant or to work out if they want to stay with the existing consultant. And they're going to be much more formal RFPs and processes, which will require a lot more
NMG assistance.
Well, professional assistance.
Professional assistance, that's right.
Potentially, but also more data and transparent around the things like we were talking about, performance fees, all these things are going to need to be clearer so we can compare.
A couple of questions here, 2 questions. What is the highest demand for managed accounts, balance, growth, income-seeking investors? And 2, how are managed accounts priced, and what distinguishes higher fee for lower value? So did you do work on the the spread across risk profiles?
Not specifically. Well, not as yet. Yeah. We do intend to go more sort of granular. We know I'd say there has certainly been a growth in income seeking portfolios, but it certainly hasn't been where the massive growth is. The growth is the main risk profiles are still the sort of the main approach. And I guess that, but the sort of limitation of that, as I touched on earlier, we do there where some advisors say, well, I like the efficiency I like that that's most of the client's portfolio that suits me, but it doesn't work for the whole portfolio, and it certainly doesn't work for all of my clients. So how do I address that?
Yep.
And we have had some. So well, that makes me consider, is an MDA more appropriate? For some though, that when they've investigated, they go, I think that the sort of the licensing, etc., scares them off a bit so far. For others, they're going, well, I use the SMA, the balanced SMA as a core, and now I'm selecting satellites around the edges.
Yeah, I mean, what I would say is there's a sort of a relatively normal, there's a sort of slightly skewed distribution curve. So balanced represents sort of 60% of portfolios, but in fact, balance has become growthier.
That's right.
So what we've seen, so yes, it's called balance, but in fact, it's heading towards what would have been described as a growth portfolio, half a decade ago. And then to Rob's second point, which is how are managed accounts priced and what distinguishes a higher fee for lower value. So
pricing, I think we're at the point now where in order for the advisor to be able to really convince or justify moving their client from, say, a paper model into an SMA construct, for instance, or an MBA, it at least needs to be cost neutral. Think that remember that the levers to get there are the portfolio fee, portfolio management, RE fees, and platform, and then the underlying. So there's a few levers there that tend to get pulled to get price, but at least neutral, and then in best case, slightly cheaper.
I think one of the challenges, and we spoke about this, or you spoke about this earlier on, which is the lack of evidence points to the improved client outcomes, because there's nothing, and we've been doing quite a lot of both thinking and work in this area in IMAP, which is if you can turn around to clients and say, look, evidence tells us, reputable research shows us that managed portfolios deliver better outcomes, and the range of better, looks like this. Therefore, the slight additional cost is justified. That's such an important thing for us to do as a profession.
Exactly. If those drivers of growth can be actually demonstrated, there's the opportunity, yes, to potentially charge a bit more. But at the moment, I think, what we see, it tends to be, at least you want to get to at least cost neutral, and sometimes cheaper, just to make the bid argument very simple.
So there's a question here: what's the SMA MDA split, and how is growth trending? So the IMAP research shows that it's about 180. This is as of December 2025. We're doing the June study right now. It's about 180 billion of SMA money and about 70 billion of MDA money, and then there's other, which is about $40 billion. So other is trustee discretion.
Yep, that's right.
So it's a sort of 2-to-1 split between SMAs and MDAs. SMAs have been growing faster.
That's right.
Again, my bias is probably showing when I say that I suspect that while they will both continue to grow, we'll start to see a pickup in the growth of MDAs precisely because they offer a degree of flexibility that it's harder to achieve in an SMA world.
I think that's hard to argue with, Toby. I think that's probably right.
There's a question, besides your liquid assets, are there other developments that you see coming?
Well, I guess liquids are one where there's been an awful amount of focus on to try to get liquids into managed accounts. We've seen Drummond with their SMA, Russell Invest Blue. That's the one that's come out recently. From what we understand, there's a queue of these waiting to come to market. So that's the most obvious area of innovation. Other areas, there is, income was touched on before. there's a growing sort of focus on retiree sort of focused portfolios, and clearly that's about yield. And given the recent tax changes, there may well be much more a bigger focus on yield again, not even driven by retirement.
I'd see when I look at New Zealand, and I don't know New Zealand in a lot of detail. It's been a long time since I lived there, but in New Zealand they've got a home country bias, which is we don't invest here, we put our money offshore. And I can see the current tax changes leading to a much heavier focus on offshore investment. I mean, it'll achieve exactly the opposite results that the government intended. You'll go, well, I need growth in my portfolio, and I'm not going to. If I go for it here, I'll be more heavily taxed. And therefore I'll have more money in offshore investments, potentially through domestic vehicles, but fundamentally offshore.
There's also an argument we'll see, more back to sort of more equity income sort of driven things like imputation funds and the like.
Yes.
Provided they deliver this time.
Yes, exactly. Alternatives. So MDA technology that allows alternatives to be integrated into the portfolio rather than run as standalone. Potentially more retirement-oriented portfolios because we've got more retirees, and that'll be also the sort of thing we've seen, I think, CFS or Evidentia do, which is the integration of annuities alongside managed accounts.
That's right. And what's the other sort of talking point at the moment? Investment bonds. The tax changes may also lead to a growth in that area. So how does that work in an SMA or an MDA construct? And as I touched on it, I think that when will we get to the point where we have more and more total portfolios made up of ETFs and getting more, and the efficiency that would come with that from an execution perspective.
Sure. And the other obvious thing that's going to impact the construction of portfolios is deeper use of AI. I mean, I look at the use of AI in our own business. Like we are just at the start of this process. So the ability to have potentially highly personalized portfolios, machine generated, is seems to me is such an obvious opportunity, and for managed account structures to be able to essentially deliver the outcome of that sort of thinking. This week's lead story in The Economist from today is essentially the personalization of AI. It seems to the lead story is just all about well, in fact, it's about consciousness. But once you start talking about our AI is AI conscious, you really start to get into a world where you think, conscious and personal. So
the young people in our business won't forgive me if I start talking about AI.
So look, I guess one of the things then, sort of back to the more routine issues. Gosh, actually, there's a lot more questions, so we won't go to that. Variety of MDA operating models. What are they, and what's the dominant or fastest growing? Okay, well, here's one I prepared it. No,
exactly.
So look, to my mind, there are really three operating models that I see used in an MDA world. Far and away, the biggest is MDA on regulated platform. You get a bunch of reliefs from reporting. The MDA is run on the platform, but all the assets have to be held in the platform. All the discretionary assets have to be held in the platform. The platform does the reporting. It's the operating model that Philo uses. The second, with the original but now second structure, is MDAs on HEN. The specialist of the brokers and increasingly some of those advisors who want to use listed vehicles. I could see that growing as more ETFs come to market. And so you go, right, I've got clients have SMSFs, therefore HIN-based services work. And the third, and very much a minority interest, is where a custody structure is embedded in the MDA service has an associated custody structure. I'm aware of one organisation that it self-custodies, but generally it would be either Citi or HSBC or with those two in particular, I think. So those would be the three operating models, I think. And I put Mason Stevens and Dash into that MDA on platform world.
Well, no one better to answer that question than you.
Yes, that's right. How would you describe the differences between an SMA and an MDA?
In simple terms, an SMA is a product structure. It's an MIS with a PDS, but which essentially describes what the SMA can and will do. And within it, you can essentially have what might have looked like a balanced fund, multi-asset balanced fund in the past. Whereas an MDA is a license sort of agreement or arrangement that essentially enables someone to manage a portfolio and make trades, etc., on behalf of their client.
Yeah.
What would you add to that?
No, I think that's it. I mean, look, SMAs are products. I mean, technically and in practical terms, and they have all the strengths and weaknesses of a product structure with an RE. MDAs are very much more service oriented, technically an unregistered scheme, but they have an agreement between the client. One of the things which probably overlooked in the MDA structure is every MDA between an MDA provider and a client is actually a unique service. So even if technology enables you to go, right, well, those 100 people are run against this model, they are actually separately 100 services. Whether it's those people in an SMA, those people are in the same product.
And I think the way we've tried to explain that in the past was also that within an MDA, there's a continuum from people can be following a model quite strictly, and everyone gets it, through to pure bespoke individual portfolios. Yes. Which SMA is quite strict.
Yeah. Gosh, a lot more questions. This has been very, so IMAP produces a managed account market share report. Is NMG involved? Well, in fact, we produce a market size report, and NMG produces a market share report. So
they're very much complementary. That's right. Toby and IMAP produce this is the size of the market and growth broken up by SMA, MDA, and other. And we've gone, okay, we'll address the level below that, which is how big is and it's really only SMAs at the moment, and it's getting into the detail of SMA types, underlying structures, and then of all of the managers, how much are they managing in SMAs across the various structures as well. And that's happy if you'd like to reach out, we can tell you more about that.
Now, we're going to wrap up in just a moment because of time pressures for Mark, but let's have a look at these last couple of questions. Is there good data on client outcomes for the cohort of clients in self-selected advisor portfolios or paper models? That's exactly the project which we have specced out with the University of Sydney as a postdoctoral study. It's just a fundamental issue. I sort of frame it as, do managed accounts work? I believe deeply that they do. And I'm extremely keen to
how do you prove it
to get to a point where you turn around and go, there is enough data here that we can say.
So the simple answer to that question right now is no.
Yes, that's right.
It doesn't exist.
Nobody's done the research, and we're pressing hard to get that research done.
And I guess we'd rather the industry do this than wait for the regulator to do it, and we get some outcome we don't want.
Yeah. And the final question, with the MDA instrument rollover almost upon us, what are the possible outcomes and likely issues or risks for MDA providers and advisors? Good question. I spoke with the chap who's heading up the project within ASIC a few weeks ago and asked him about, what were they going to do now? In good bureaucrat speak. I didn't get a lot out of him. It's going to be substantial but not fundamental, I think, is the exact quote. I'm not anticipating. A change in the net tangible assets requirement. I asked specifically about that, and he said he said in our conversation, if we were going to do that, we would have a consultation process. It's a significant issue. There would be a consultation process, and we would deal with it separately, as they have done with NTA for managed investment schemes. And the result of that has been inflation adjustment rather than fundamental change.
Yeah.
So we could see that. We could see changes to the way in which advice is provided on MDAs, for example. So I could see an analogous set of performance monitoring obligations to those that apply to the super trustees being applied to MDA providers. So, that it seems to me that those things are in the zeitgeist.
Yeah.
Never mind about MDAs. They are just,
And we haven't
in
even
the air.
didn't even get to touch on performance tests today,
Yes,
which probably need its own session.
Yes, that's right. And so finally, what can you tell us about the IMAP summit at your end? What's the value? Who's invited and what's covered? We'll be focusing very much in the summit on actually drilling down in detail into the changes that the instrument has given rise to, whatever they are. So it'll either be a head and hands moment, or it'll be a kind of let's move on moment. But we will be dealing in detail with the changes to the instrument. But more importantly, assuming that we all end up with an instrument that provides a good sound base for the next 10 years of service delivery, we've got 3 streams: a regulatory stream, a sort of a client stream, and an investment stream in that session. So look, thank you very much to those of you who've joined us today. Let me just remind you of that summit and of the activities which we've got going on through the rest of the year. The masterclass dates and the summit date. So thank you to those of you who've joined us this week. I hope you've found it valuable. We value your comments. You'll all receive a Survey Monkey shortly, and we look forward to you joining us at future IMAP events. Thanks very much.
Thanks, everyone. Thanks, Toby.